The most significant financial market in the world, foreign exchange markets or forex, is extremely highly liquid and widely available for worldwide trade and investing. It operates around the clock across an extensive global network of financial hubs, which are only closed for transactions during weekends. However, when one significant currency hub winds down, yet a further center in other parts of the globe is still running for business. As a result, these markets have more liquidity, which makes them more appealing to traders as the most valuable asset class. Banks, firms, central banks, financial institutions, and investors of all kinds are just a few of the various parties who participate in forex markets. They all purchase, sell, exchange, and wager on monetary values to convert currencies through global financial deals and expenditures is also made possible by the forex market. Converting one nation's currency into a different one is the foreign exchange market's principal and fundamental goal. In addition, telegraphic transfer, metal trade, drafts, bills of exchange, letters of credit are used to carry out the role of transfer. The most significant and efficient way for two parties in separate nations to trade purchasing power is through a bill of exchange. Next, the issuance of credit to the importer debtor is another vital component of the foreign currency market. On the importer's bankers, the exporters draw the bill of exchange. When the bills mature and are accepted by the buyer or associated financial institution, the exporter will receive the money. The bills are often discounted with the assistance of bankers, foreign exchange banks, or discount firms if the exporters are eager to get paid sooner. Last but not least, providing risk protections against foreign exchange is the following goal of foreign exchange. They represent the outcome of exchange rates that are always fluctuating. Each nation has a currency that is used to determine prices for products and services. For instance, the US dollar is the dominant currency in the USA, while the pound is accepted in Britain. The euro, which is the most widely employed among European nations. Exporters will benefit if the rate is favorable and vice versa. The foreign exchange market offers protections or legitimate claims through advance agreements in exchange or receipts to reduce the associated risk. Foreign exchange payment at a predetermined rate is guaranteed by foreign currency agencies. The exchange agents are responsible for the risk associated with exchange rate fluctuation.
I will explain the three main types of exchange rates. They are fixed exchange rate, floating exchange rate, and managed floating exchange rate. Exchange rate means the value of one country's currency compared to another currency, such as the Malaysian ringgit compared to the US dollar. First, fixed exchange rate. A fixed exchange rate is a system where the government or central bank controls the value of the currency. The exchange rate is kept at a constant level and does not change freely in the market. To do this, the central bank may buy or sell foreign currency. Example, if $1 is fixed at 4 ringgit, the central bank will take action to keep the rate close to this value, even when market demand changes. This system usually used to maintain currency stability and reduce sudden change in exchange rates. Second, floating exchange rate. A floating exchange rate is determined by demand and supply in the foreign exchange market. The value of the currency can change daily based on economic factors such as trade flows, inflation, interest rates, and investor confidence. For example, if many people want to buy US dollars for imports or investment, the ringgit will weaken. If demand for ringgit increase, the ringgit will strengthen. In this system, the government does not directly fix the exchange rate and the currency is allowed to adjust naturally. Third, managed floating exchange rate. A managed floating exchange rate is a combination of fixed and floating exchange rate. The exchange rate is mostly determined by the market but the central bank may intervene when there are large or sudden movement. For example, if the ringgit weak too quickly, the central bank may step in by buying ringgit or selling foreign currency to stabilize the exchange rate. This system allows the currency to move with the market while avoiding extreme fluctuation.
Next, I will explain advantages and disadvantages of foreign exchange market. Firstly, one key advantage of the foreign exchange market is high liquidity. It allows currency to be bought and sold quickly, which support international trade and investment. Secondly, the forex market offers low transaction costs, making currency exchange more efficient for businesses, especially for exporters and importers. Another important advantage is risk management through hedging. Companies can use financial instruments to protect themselves from exchange rate fluctuations and reduce uncertainty. However, the foreign exchange market also has several disadvantages. One major disadvantage is high volatility, where currency values can change rapidly due to economic or political events, such as during the COVID-19 pandemic. Another issue is leverage risk, which can lead to large losses, particularly for inexperienced traders. Lastly, the forex market is complex and highly competitive, and it is dominated by large financial institutions, making it a challenge for small participants.
Now I will explain about the factors that affect exchange rates. So, why the exchange rate move up or down? Exchange rates goes up or down because of how many people demand a country's currency. If many people want it, the value goes up, which means appreciates. But if fewer people want it, the value goes down, which means depreciates. First factor is interest rate. When a country has high interest rates, investors will put in their money to earn more profit. This increases demand for the currency and value rises. For example, if Malaysia's interest rate becomes higher than Singapore, investors will put money in Malaysia and ringgit will go up. Second is inflation rate. Countries with low inflation usually have stronger currencies. Low inflation means goods are cheaper, more people will buy exports, and higher demand for currency. For example, Japan will keep their prices low and more countries will buy Japanese product, which means yen becomes stronger. Third is trade balance, which means exports and imports. If a country exports more than it imports, foreigner must buy its currency, so the value goes up. But if the country imports more, then they need more foreign currency and its own currency becomes weaker. Fourth is economic growth, which means when a country's economy grows well, many investors want to invest there. More investment means more demand for the currency, so the value will increase. Next is government debt. If a country has too much debt, investors will feel it is risky, so they will avoid the currency and the value of the currency falls. Factor number 6 is political stability. Stable countries attract more investment. Meanwhile, unstable countries will scare investors away. For example, if the UK has political uncertainty, investors will pull out their money and British pound drop. 7 is speculation, which means expectation. Currency traders will buy or sell based on what they think will happen. If they expect a currency to rise, they will buy more, making it rise for real. For example, if traders believe that the US dollar will get stronger, they will buy dollars now and price actually goes up. Lastly, central bank intervention. Central banks can force the currency up or down. They buy their own currency to raise its value or sell it to lower its value. For example, Bank of Japan sometimes sells yen to weaken it, so Japanese exports stay cheap than other countries. Next, we move to the case study. The first case study found that over the past 10 years, the Malaysian ringgit has generally become weaker against the major currency like the US dollar, Singapore dollar, and euro. Big external factors caused this, especially the aggressive interest rate hikes by the US Federal Reserve and the slow recovery of China's economy. In 2023, the ringgit even fell to one of its lowest points in history against the US dollar and Singapore dollar. although it sometimes strengthened when the US dollar lost momentum, the overall trend shows a slow and steady decline. However, analysts expect the ringgit to recover if the US interest rates drop and Asian countries' economy improve. For the second case study, the study found that the ringgit's long-term value, especially against the British pound, is strongly influenced by two things. First is how much money Malaysia puts into the economy, and second is the world crude oil prices. When Malaysia increases its money supply, the ringgit becomes weaker. But when global oil prices rise, the ringgit gets stronger because Malaysia is an oil exporting country. The ringgit did not show the same long pattern against the US dollar, meaning different factors influence the exchange rate. Overall, the research shows that the Malaysia's currency is sensitive to oil prices and economic policies, which explains why the ringgit has gone through several periods of depreciation.
Today, I will explain how exchange rate fluctuation affect the Malaysian economy, especially change in the Malaysian ringgit. Over the past decade, the Malaysian ringgit has generally weakened against major currencies like the US dollar. This depreciation has both positive and negative effects on Malaysia's economy. First, let us look at the positive impact. When the ringgit becomes weaker, Malaysian exports become cheaper for foreign buyers. For example, if Malaysia export electronics or palm oil, overseas buyers can purchase these goods at lower price when Malaysian ringgit is weak. This helps export-oriented industry increases and support economic growth. However, there are also negative effects. Malaysia depends on imported goods such as machinery, oil and food. When the ringgit weakens, import price increase. For example, import oil or raw materials become more expensive, which increase production costs. As a result, price of goods rise, leading to inflation and a higher cost of living or household. In addition, a weak ringgit can affect foreign investor confidence. If investors see that the currency is unstable, they may be less willing to invest in Malaysia. This can lead to capital outflow and higher financial market volatility. Furthermore, a weaker ringgit increases the cost of paying foreign denominated debt. For example, if a government or companies borrow in US dollars, they need to pay more ringgit when Malaysian ringgit depreciates. This puts pressure on government finance. In conclusion, while a weaker ringgit can support exports, excessive exchange rate fluctuations can cause inflation, reduce investment confidence, and increase economic vulnerability. Therefore, maintaining exchange rate stability is important for Malaysia's long-term economic growth.
To conclude, the foreign exchange market is essential to the trade world. It acts as a worldwide platform for the exchange of various national currencies. It differs from marketplaces like the stock trading platform. For example, in Malaysia, Bursa Malaysia Marketplace, which have established exchanges and central offices in that it is a large flexible network. Because of its decentralized structure, the foreign market is not covered by a single entity, but rather is impacted by a wide range of variables and participants. Being familiar with the foreign exchange market is essential for professionals and experience who operate in today's integrated world of commerce. Whenever one thinks of the foreign exchange market, recall that it's an intricate and intriguing field with significant effects on financial markets and companies from all over the world.